Welcome back to FT Markets. Greece is clashing again this week with its creditors in Europe. But behind all the drama is a bigger issue about how Europe deals with debt in the longer term, not just in a matter of weeks, but over decades, the lifetime of olive trees. With me to discuss how Greece's debt problems could perhaps be linked with its economic growth potential is Alberto Gallo, who's Head of Credit Research Strategy at Royal Bank of Scotland. Alberto, welcome to the Financial Times. I know we can discuss some specific ideas for Greece and how it could deal with its debt mountains in years to come. But the general point is that Europe, you think, needs to find new ways to tackle high levels of debt. Why is that?
Well, I think the eurozone is stuck with an impossible trinity. We have a central bank that cannot monetize debt. It's forbidden by the ECB mandate. We have no fiscal union, so rich countries cannot help poor countries. And we don't have flexible debt markets. In the private sector or in the public sector, it is very hard to fail.
Okay, let's look at Greece specifically. And the first chart we brought along is looking at some of the trajectories for Greek debt, showing Greek debt as a percentage of GDP going out for the, well, till 2022, essentially. What are you showing here? Too much optimism around you?
Yeah, I mean, the IMF has never been blamed for excess pessimism. And their Goldilocks scenario that Greece is going to have a decade of 3.5% growth and 4% surplus. That's clearly not realistic. What's probably going to happen is that either you'll have a recession at some point in the future,
the green line,
or maybe we will not grow fast enough. And so we can easily go back to a very high debt level. Even though interest costs are very low, you can go back to a very high debt level, which may not be sustainable.
So in other words, even if they sort out problems for now, the risk is that Greece will continue to have these extraordinarily high debt levels, very high by global standards, for years to come.
And in a situation where 1 out of 2 young people are unemployed, being not able to do any social or pro-growth policy may not be socially sustainable. In practice, any projection which goes 10 or 20 years from now with austerity and the Troika may not be socially feasible.
One idea that's been put on the table, which I think you're in favour of, is this idea of GDP-linked bonds. This has been proposed by the Greek Finance Minister, Mr. Varoufakis. Explain very briefly, what is a GDP-linked government bond?
Well, if you think about growth cycles in Europe, you have a central bank which follows the eurozone. If in the future Malta or Luxembourg or Greece, a small country, are going to have a recession, it is very unlikely that the ECB will help them if Germany is growing and there is high inflation as a whole in the eurozone. Exactly. And similarly, pre-crisis, the ECB was keeping rates low, even though there was fast growth in the periphery. So flexible bonds can provide an extra channel of flexibility particularly good for the small countries.
And the idea is that when the economy is doing well, they pay
more interest, and when the economy is doing less well, you pay less interest.
Okay, you can make a lot of objections to these. I know that, I know you're aware of these arguments. There's the risk of these bonds being much more volatile, difficult to price. There's the question, of course, whether countries would simply fudge their GDP figures.
Yeah, I mean, there are ways around this. Obviously, this is not a free lunch. It shouldn't be a free lunch, and you can check the GDP figures much more easily today than 20 years ago. You can link the bonds to tax revenues if you want, to harder numbers. Okay,
but what you've done at RBS, you've looked at various scenarios for countries like Greece. If we call up our second chart, showing how debt to GDP ratios could change under normal bonds and GDP-linked bonds. The point of your analysis, the result of your analysis is?
Well, if you're a country like Greece, 20 years from now, if you use anti-cyclical debt, growth-linked bonds, you have a much lower chance of ending in a high debt level.
This is the danger area, the red line.
The danger area on the right, where your debt to GDP is very high. You give up some of your upside, but you also eliminate, which is on the left, but you eliminate a lot of the probability of having to do austerity when growth is low. So ending up in a negative loop of austerity and
more likely to be in that safer area where debt levels are. Yeah. How likely do you think we're going to get GDP-linked bonds in Europe?
Well, unfortunately, I think the negotiation is not going there. But I think eventually Europe needs to change something. Either we have to have a fiscal union or more flexibility to allow a resolution or restructuring of debt overhangs, even in the public sector.
Alberto, I think we're going to have to stop there. So, idea of GDP-linked bonds backed by economists and people like Alberto, but whether it will succeed politically, well, that's a different question.